Market update today is Monday, February 9th, 2026, and we'll jump right in. Markets had a risk off week as investors rotated out of technology and into more defensive sectors with a partial recovery on Friday. Value stocks outperformed, led by a 2.5% gain in the Dow Jones Industrial Average, while the S&P 500 was nearly flat, down 0.1% last week, and the Nasdaq Composite underperforming all three, down just over 1.8% last week. Moving into some economic data, with January's BLS employment report delayed by the 3-day federal shutdown, the ADP employment report provided a preliminary look at labor market conditions last month. Private employers added 22,000 jobs in January, reinforcing the trend of very moderating employment growth. By sector, education and health services added the most jobs during the month, while professional and business services lost the most jobs in the month. Hiring was strongest among mid-sized firms with between 50 to 500 employees, while small business employment was flat and large employers reduced headcount by 18,000 jobs during the month. Overall, this reflects a labor market that remains stable but continues to show limited momentum. Another labor market indicator that came out last week, the Challenger Jobs Report, pointed to rising signs of economic strain early this year. US-based employers announced over 108,000 job cuts in the month of January, an increase of 118% from the same month last year. It was also the highest level of job cuts announced for a January since 2009. Transportation led all industries with 31,000 job cuts, largely driven by major layoffs from UPS. Technology followed with 22,000 job cuts, most of which came from Amazon. Reported reasons for layoffs were primarily led by contract job losses, followed by market and economic conditions as the reason, while restructuring and department cuts accounted for a lot of the rest. AI was cited in about 7% of the total job cuts in the month. Overall, we're seeing a more cautious start to the year, especially in labor markets. Moving into some earnings from last week, both Google and Amazon posted mixed results that weighed on risk-off sentiment last week. Google beat expectations on both the top and bottom lines, but unsettled investors with plans to more than double capital spending in 2026 to support its AI initiatives. Amazon beat revenue expectations but missed on earnings, and similarly surprised markets with a much higher expected CapEx outlook. Both stocks faced pressure during the week as investors questioned the scale of their planned spending, alongside just a broader market rotation out of the more risk-on sectors like Amazon, like Google, and technology. Other data we got last week included both the ISM manufacturing and services indexes. Manufacturing conditions improved in January with the index rising to a pretty bullish 52.6%. You can see that's the highest reading in several years here. It's also the first expansionary above 50% reading in 12 months. The improvement was driven by stronger new orders, production, imports, and exports. Employment conditions also edged higher but remained in contractionary territory, indicating labor demand in manufacturing continues to lag. Still, overall, we can see it has been trending up very slowly since reaching a bottom in 2023-2024, and let's hope the trend continues in that direction. The ISM Services Index remained strong in January, holding steady at 53.8%. Growth was supported by robust business activity and new orders, though employment softened slightly and inventories contracted, turning bearish for the month. Together with the ISM Manufacturing Index, the reports suggest a more stable and moderate economic outlook in the near term. Last but not least, consumer sentiment from the University of Michigan showed slight improvement in February, rising about 1.6% month over month, but it was still over 11% lower than a year ago. Sentiment increased sharply among consumers with the largest stock holdings, while it was stagnant and at quite low levels for those without stock positions. On the more positive side, year-ahead inflation expectations fell to 3.5% from 4% last month, and this was the lowest reading since January 2025. Sentiment is now at about a 6-month high, the highest since August of 2025, though as you can see, it still remains well below pre-pandemic norms. So that concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.